So as we mentioned, D small would be debited and the return outwards account would be credited. So goods sold for cash is the next entry. So it's similar to a sales entry. The only difference is rather than selling it on credit, we sold it for cash. So goods sold for cash. The two effects would be there is a sales and then there is a cash. Sales account is always credited, and when we sell the goods, we have cash coming into the business. So the cash increases, which means cash would be debited by 210. So sales would be credited by 210, and the cash account, which you can see downstairs down as I'm scrolling, would be debited by the same 210 amount. Now goods bought for cash, again it's a purchases entry which involves cash, so there will be purchases would be debited by 150 and cash would be credited by 150. Moving on to the next entry. Now M Spencer returned 16 pound goods to us. When M. Spencer returns good to us, it means we have returns coming in. So it's a return inwards. Return inwards account, as we explained above, is always debited because return inwards entails an increase in the stock that we have. So we know that the return inwards account would be debited by 16. What about the other entry? M. Spencer was a was a debtor who we had debited initially. Now, because the asset is reduced by 16, we would credit M. Spencer. So the return inwards would be debited by 16, and M. Spencer would be credited by 16, which we can see here. Return inwards is debited by M. Spencer 16, and M. Spencer would be credited by 16, reducing his asset. Goods sold for cash, again, the two, it's a simple entry. We'll look at the two effects, sales and cash. Sales is always credited, and cash, because it's a sales, cash is coming in, cash would be debited. The next one is paid cash to D small. Now D small is our creditor. So D small, so the two effects would be cash we have paid. Whenever we pay cash, it means cash would reduce. So cash would definitely be so cash would be decreased. So cash would be credited. D small is a creditor. So when a creditor decreases, it's debited. So cash would be credited and D small, who is a creditor, would be debited, which we scroll down, we can see. So D small 205 uh, debited and cash account 205 would be credited by the same amount. Going on to the second last entry, D. Hughes paid the amount owing by him £60 in cash. Cash coming into our account because D. Hughes paid us. So cash would be debited because it's an increase in asset. Hughes was a debtor, which means an asset account. He has paid the amount he owed to us, which means that the debtor account would be reduced. Debtor account is an asset account. When it's reduced, it would be credited. So cash would be debited and D. Hughes would be credited. The last entry we look at it, bought goods on credit 214 from A. Loyens and Son. This is again, we need to look at the two effects. Bought goods means purchases. Purchases here is on credited from a creditor. So purchase account would be debited because the stock has increased. A. Loyens is a creditor, and when a creditor increase, it's credited because it's a liability account. So we would debit purchases by 214 and we would credit the A Loyens account by the same amount, 214. So that is how generally stock is recorded in terms of sales, purchases, return inward and return outwards. Here we further explain the words of sales and purchases. Sales, so it would be good if we can understand what purchases is and kind of at least know and be able to explain these terms when they come in the exam. So purchases is accounting means the purchase of those goods which the business buys with the prime intention of selling. So purchases is not what we purchase to use in the business. It's to use in it's the we purchase those goods to sell it at a later stage with an intention of selling and making a profit out of it. So for example, if we are a furniture company and we make furniture or we purchase furniture to sell it to different suppliers, then that, or to suppliers and customers, then whenever we purchase furniture, because we would be reselling it, it would be considered a purchase. Whereas a toy shop, if they purchase furniture like a desk to be used in their office, that would not be purchases. That would be classified as fixed asset, because the piece of furniture that they have bought, they've bought to use it and not to resell it to make a profit. So that is a key differentiation between how to classify any asset into purchases or as an I or as an another item of fixed asset. In terms of sa- sim- sales means the sale of those goods in which the business normally deals and which were bought with the prime intention of resale. So if a furniture company sells furniture, that would be classed as sale of goods. Whereas if a toy company, if it sold a piece of desk or another furniture, that would not be called as sales, because the toy company does not trade in sales of furniture. So that is the key differentiator, whether the what was the prime intention, whether it was bought to be resold or whether it was bought to be just kind of like used by the business in terms when it was when the business was being conducted. Now, comparison of cash and credit transactions for purchases. This we sort of covered in when we were doing the examples. So, uh, whenever cash or sales, so the cash or purchases, they can either be, so the purchases or sales of goods, they can either be in cash or they could be credit. So no matter if it's on credit or cash, the purchases and sales account entries would be the same. It's only the corresponding entry which would either hit either the cash account or the debtor or the creditor's account. So here it's more explained here, and we went through it in more detail in the examples as well. So we'll move on to the difference. So here this box explains the difference between the treatment in cash sales or credit sales. So if it's a cash sales, it's a very simple entry, would be debit the cash account because it increases our sales, it increases our asset which is cash, and we would credit the sales account. Sales account is always credited whenever we make sales. If it were, however, the sale was made on credit, we would have sales which would of course be credited, but instead of debit in cash, we would debit our debtor's account, which would be an asset. So we would debit the customer's account and we would credit the sales account. Eventually, when maybe in a week's time or a month's time, when the customer actually pays us money, what we would do is we would have cash coming in. So we would debit the cash amount account, but because the debtor would be paying away his liability, which was an asset for us. The debtor is an asset, so because he's clearing off his amount, he would be debited because because the asset of debtor is reducing, so it would be credited. Sorry. So we'll debit the cash account and we will credit the customer's account. So a cash sales would just have a a single effect, whereas the credit sales would have two parts to it. So that is what generally would be involved in the stock account, and how to record the different angles that would increase or decrease our sales. So I hope you understand it and do look through the examples that are there. Thank you.